I put graphs up. I put graphs up in class. I showed ones with premiums, ones with discounts, and ones that were at market price all the way. And where they all wind up at the exact same place. Where? What are you going to get when the bond matures?
Face value.
Face value.
Face value.
Yeah, mature.
Face value.
Yeah. So when you do the multiplication,
Yes.
you get a different decimal number in the 100th place as opposed to doing the division of the interest payment and the current yield.
Man, when I say this class gets into minutia, they get into minutia.
Well, there's an equation.
It's 300,000 times 131.84%. It is that freaking simple.
And I have to. That's why I'm stuck, because I have two answers. Because in the book, it gives the equation of current yield equals annual interest payment divided by present value. Well, you don't have present value, so you solve for present value, and it gives you a number.
We have a, is that a masochist or a sadist? That's a masochist, right?
I don't know what this
We have someone who wants to make their life 10 times more complicated than it needs to be.
sounds good to me.
But you mean 300 million, right? 'Cause that's
Yeah,
what it
300
falls
million,
off.
whatever.
I just want to. I mean,
But they ask for everything in millions, so that is a thing you need to be very careful of, okay? I reviewed a accountant 2 assignment with one student who did very, very poorly and thought she knew nothing about accounting, and she actually had an A, except she didn't know how to read instructions. Okay, when it says 2 decimal places, it means 2 decimal places. When it says whole number, it means whole number. It's a computer, it's stupid. If it says give me a whole number and you give it a decimal, you're wrong. Okay?
Okay.
So,
Thank you for calling that out.
and if you take it to the 100th decimal place and they're asking for it in whole millions, you should be okay either way.
C is asking for round to the. Wait a second.
It says round to 2
Yeah.
decimal places, but it's asking for
Okay.
millions.
Yeah, but in millions.
So the decimals are just zeros.
No.
It's just 300.
Okay, so what else on this question? Do you understand this question now?
Well, mine was up above that one. D's the face, that one right there, C. See, it said if they've repurchased the 7.125 notes at the quoted market price of 131.84.
Yeah, that's what we just said. That's what we just talked about.
Yeah, that's the one I was talking about. But yeah, we're good. He asked if we're good with that question.
Okay.
Yeah.
I'm sorry. Thanks, Oz. Thank you. Thank you for taking back to 5th grade there. Right? Wow.
All right, I'm standing here waiting, looking at a bunch of blank faces. Looking at my screen, looking for a question out there in
I'll go again.
Yeah, you said earlier that.
La La Land.
Yeah, you said earlier that the on still on number 4. I was trying to write everything down. Obviously, there's a coupon rate and a market rate,
Yes.
and when the market rate. Let's see. Hold on, let me just reread the question. Oh. They're not reporting any interest expense in their they don't have to report the expense in their statement until it's time for it to be due, right?
No, what are you talking about?
I'm trying to understand how the market rate impacts the interest expense.
Oh, okay, so you're asking, okay, the difference, what are they reporting in interest expense? Well, as long as this note is outstanding, and as long as they issued it at par, which they did, okay, their interest expense is the coupon they're paying.
It doesn't ever change.
It doesn't ever change, okay? Because that's truly their expense. Even if their expense is well above market, their expense is what they're paying.
Okay.
So there's another question that asks, well, what happens if they retire these things? Okay, is it gonna be a gain or a loss, what have you? I mean, they're paying way more interest than they should be paying. So in order to stop that, what can they do? They can go in the marketplace and buy these bonds, but they can't buy the bonds for the $300,000 million that they owe because they're trading at a premium. So they have to buy them back at a premium. So they're gonna pay more. So when they pay more and they eliminate their liability, they're gonna have a gain or loss recognition then on the retirement of those bonds. Okay, but the interest rate is what they're paying.
I have a question, but you guys,
Go for it, Jason.
this was one of the verbiage in question 10. Doesn't mean we're skipping all the questions, but just to. Oh, you can go back to it. It says during 2011, the company sold, but going to bonds payable of 117,000 were retired for cash at a loss.
Yes.
So that bonds payable of $117,000, that's actually an account on the balance sheet, and that's the current carrying liability of that 117,000. They're saying it's retired for cash. That means they had to pay it. They had to buy it back. They bought it back, and there was a loss of $500,000. So on the statement of cash flows, you're showing the full cash effect of that retirement of the bonds payable, right?
That's correct.
Okay. So then it's factoring in that loss and the bonds payable amount on the balance sheet for a total cash flow on the statement of cash flow. Is that, I'm trying to say it.
Okay, so the question, and I'm repeating things so that I can speak into this microphone and the people out there on the webinar can hear me. Give me 1 second, because I think my laptop went to sleep. Okay. All right, so the question deals with question 10 in the statement of cash flows. And this whole question deals with a lot of, accrual to cash type computations. But the main question is the word dealing with the retirement of bonds. And the question that was asked says that it states that the bond was retired, and it says bonds payable of 117,000 were retired for cash at a loss. So when we're talking about cash flows, do we care about gains or losses? No, we only care about cash inflows and cash outflows. So in the finance section, we have an outflow for the retirement of this bond, and based on the data given, you have to determine what that cash outflow is. The 117,000 was the face amount, okay? And that in combination with your income statement, which is gonna provide you with a gain or loss figure, you should be able to determine what they actually paid for that bond, and that would be a cash outflow. It'd be shown as a negative number under the finance section of the cash flow statement. Okay. Yes. Someone out there trying to ask a question?
So, Professor Ray, this is Kyle. I have put one in the chat there. It's still on the same question, hopefully it's number 10, and then just one line down with that payment of dividends versus the issue of common I'm just trying to sort it out now with what you said about the, bonds payable and cash in the law.
Okay.
Do you mind answering the question or no?
All right, I see your question in the queue now, so let me read the question and see if I can answer it. So, question 10, issuing a common stock would have increased by 24,000 cash flow. Question, would you then use the same approach using retained earnings to find payment of dividends? No, you would not, Kyle. The dividends are given, okay? As additional information, because there's more things that affect retained earnings than just dividends, right? So you have your income coming in, increasing it, and your dividends decreasing it. So the dividends are provided in the written verbiage of the question itself. The issuance of the common stock, all they mention is that any increase in common stock was for cash. So looking at the balance sheet, if you remember from the very first accountant class, when we talked about equity, we said there was two portions of equity. There was earned capital and there was contributed capital, okay? So the contributed capital is the common stock account. So if that common stock account has increased and it says it was all for cash, you should be able to assert how much cash was received for the sale of that common stock, okay? And it would be the change in the common stock account as well as the additional paid in capital common stock if that account existed, which it does not on this particular example. So the cash received for the stock is pretty straightforward. Just look at the beginning and end in balance sheet and determine the difference, okay? The dividends is actually just flat out given to you in the written narrative.
Okay. Got it.
Okay.
I got a question, so I'm going to Kevin, you have a question?
Yes. Go ahead.
Hold on, let me find my other question. One sec.
While we're on this question and people are looking for other questions, let me highlight another thing about the statement of cash flows. So the statement of cash flows, when we talked about in class, the direct and indirect method, we're using the indirect method here. I gave you a little grid that should be helpful. If an asset increases, it subtracts. I drew a little square on the board and made a box and plus and minus, and I filled that in. So a lot of the numbers are just given, you drop them in. Your increases and decreases in current assets, current liabilities. Pay attention to the grid. What happens if an asset increases? What's the effect on cash? Okay, it's negative, okay? And if an asset decreases, it's positive, the effect on cash. The opposite is true with liabilities. But there's also supplemental disclosures required, right? We always have to disclose how much cash was paid for interest and how much cash was paid for income tax. If you are not astute to the fact that these are accrual-based financial statements, you might go right to the income statement and look at interest expense and assume that that is the cash paid. That is not the cash paid. That is the current year expense. There is a beginning liability for interest payable and an ending liability for interest payable. The same thing is true with the income tax expense. So you need to convert the accrual-based income statement number to a cash outflow. And you'll do that by looking at the change in the liability as well as the expense. Don't forget to look at the change in the liabilities. Otherwise, you're just going to pick up the expense and you're going to be wrong.
Change in accrual method. Look at the change in liability in the expense. What did you say?
Mm-hmm. i.e., I'm telling you, the supplemental disclosures where it says cash paid for interest is not the interest on the income statement.
talking about the income tax payable account? No, you're not. No, you're not. Interest payable. The interest payable account on the balance sheet.
I think I gave sufficient hints there for you to go home and figure that out. Okay?
I mean,
Supplemental disclosures down below. The bottom part of question 10 asks you how much cash was paid for interest expense and how much cash was paid for income tax. Okay. All I'm telling you is it's not the number on the income statement.
I had a question. Is it also okay to say, for what you were saying about the plus and minus in your grid, is it okay to say for assets that you pretty much take the prior year minus the current year?
Yeah.
You can always do that, right, for assets, and then liabilities, it would be the current year balance minus the prior year.
Yes.
Say that one more time.
Liabilities,
Uh-huh.
current year minus prior year. It's what he was saying on his grid, I just
Yep.
was trying to like process it, like assets, I wrote prior year minus current year on the balance sheet.
Okay, I wrote that down too.
What else? The room is silent. The audience out there is silent, so I don't see any more questions posted in the chat room.
I have a question.
Okay.
This could be in general, but it's the language I'm trying to process. So, for example, language in question number 8. It says that, and I'm looking at the retiring bond statement again, and the last part of that sentence, and retiring bonds with a face value and book value of $280,000 at an $18,000 gain.
I don't see what's confusing about that.
No,
language.
well, so I see what they're asking for there, but, I just wonder why do they give you the 18,000 gain? It's not interesting to me. Why is that of interest? The $18,000 gain, when if they're retiring bonds with a face value and a book value of $280,000.
Because without knowing the gain or loss, you don't know what they paid for.
It says the face value and the book value.
The face value and the book value, all that says is when it was sold at par. There is no premium or discount, okay? You gotta get back to the amount of cash that was paid to retire them. If the bonds were originally issued at something other than face value, you would have multiple accounts on the balance sheet. You would have the bonds payable as well as premium or discount on the bond payable, and you'd have to net those two, okay, along with the gain or loss to decide how much cash was paid. So they're telling you that those two are the same, i.e. you don't have to look for anything else.
It was sold at par, that's what
It
they're
was
telling
sold
me
at par, that's all that's telling you, it was sold at par, okay? If the value on the balance sheet is $280,000, that's what they received when they sold it, okay? So there's only one account, bond payable, there's no premium, no discount, and they retired it at an $18,000 gain. Okay, so what did they pay for it? I mean, ultimately, you got to show what was the cash flow from the retirement of those bonds.
And just in a general situation, if a company buys a bond, sells a bond at par, no matter what the amount is, when they retire it, how would they obtain a gain on that bond?
They pay less for it than what the carrying amount is. That's how you get a gain.
Yeah, but who would do that? The What would be a situation where that would occur?
Market interest rates have changed since the time the bond had been issued, and the bond now will sell at a discount or a premium in the marketplace. So they'll go into the marketplace and they will buy it at other than par value.
Okay, so in this case, the interest rate, so since that company got a gain, they retired it.
Interest rates have fallen. No.
No, that's right.
Yeah, the
Okay.
price of the bond went down, interest rates
Right.
went up. Interest rates went up,
Okay.
yes.
So when interest rates go up, the value of the bond goes down,
Yes,
and they retire it early. That's why the company would want to retire it early, because they don't want to be paying that high interest rate anymore. Right?
Well, depends on the outlook that they see. If that interest rate keep increasing, then they will wanna go ahead and retire. If you
Yeah.
say that there's a chance that it will come down,
Right.
then they
So
will not.
let's assume that in this, I'm going to the, let's assume that the interest rates keep climbing, and this company, as the owner, I'm saying, I don't want that bond out there anymore to keep paying the coupon rate. I'm gonna retire it.
no. You're
Oh.
thinking completely wrong, because the coupon rate have them locked in at a lower rate.
Yeah. What I mean is that coupon rate is steady. So when the market interest rate goes up,
And the value of the bond goes down,
Down.
okay? They can't buy it back and refinance it and save interest. The only reason they're gonna retire it early is they have excess cash flow or what have you. Or they're doing some window dressing, because they can also recognize a gain on their income statement and help them meet their earnings per share or what have you. But generally, you're not gonna see bonds retired at a gain, because market interest rates are higher than what they're paying. So if I'm sitting here with a 4% mortgage, okay, and I have some type of windfall and I have some excess cash, and which my wife will always say is, Dave Ramsey person, no debt, paid off the mortgage. I'm like, it's 4%. I make 20% all day long with it. Why would I do that? Okay, so. Questions? Question 9, is payment of income tax considered operating activity? So now the big difference between the statement of cash flows and the income statement, right? So that was the crappy question on the Finance 2 assignment, dealing with, is it an operating activity expense? Well, look at the statement of cash flows to answer that question. I'm not going to answer it, okay? But what do you start with? You start with net income, okay? And net income is after income tax, right? And any adjustments you make in that operating section is not dealing with income tax. So based on that information I just told you, you should be able to come to a conclusion whether it is operating activity or not. Another way to look at it is you got operating, financing, and investing. So is it financing? What's financing deal with? Okay, the operating section of the cash flow statement basically comes from the income statement, as well as changes in the current assets and current liabilities other than cash. The financing deals with long-term debt and equity, okay? I don't think you find income taxes on long-term debt or equity. And investing section deals with long-term assets, okay? Investments in property, plant, and equipment. So intuitively, it should be pretty easy on the cash flow statement to determine where income taxes impact it. Okay, so up to this point, we went through question 1, 2, 3, 4 in detail, spent a decent amount of time on question 10, right? So, quick review of the other questions since I don't see any questions coming my way. And if I don't, I will call it a wrap here pretty quickly. But looking at question 5 is purely present value calculations. Refer back to the task out at the Ridges as well as your present value finance assignment. This is telling you to use the tables in the Appendix A, present value table factors. Don't waste your time. Use Excel. I tested it. There's no rounding errors. I did them all in Excel and I got it. They're all marked correct as long as you use the right number of decimal places they ask for. So by using Excel versus using the table, you're not going to be off by 1/10 or of a percent point or something to make it wrong. So if you want to use the tables, use the tables, but I don't know why anyone would do that in today's day and age. $130,000 received 10 years hence. By the way, I questioned where they say 10 years hence. They don't really tell me whether, so now I'm going to play a Jason. Well, 10 years hence, is that the start of the year or the end of the year? Because it doesn't say, okay? And I thought that might have been a little trick because here's the basic rule on annuities. Always, 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 always. The basic rule is it's an annuity due unless they tell you otherwise. That means the payment's at the end of the year. If it's an ordinary annuity, they must specify payment is the beginning of the year. But when they say 10-year hence, I thought, they're trying to trick us. 10-year hence from today, it's beginning, or 10 years hence from today, it's the beginning of the year. But I went with my gut and I used an annuity due, i.e. type 0, not type 1, and all of the answers were correct, okay? So they're pretty straightforward present value calculations. You need to be careful. What is a lump sum? The first one is 130 received 10 years hence. That's a lump sum. You're not getting $130,000 every year for 10 years. You're getting $130,000. So $130,000 in this case is the future value, okay? Payment is when you receive annual payments. Okay, some of them are annuities. 3,000 received at the end of each year for the next 8 years. Now that's an annuity because it's each year. An annuity, by definition, is a series of equal periodic payments. Okay, so the $8,000, $3,000 in Part B is a payment, not a future value. The other thing you got to be cognizant of is what happens when we have more than one payment per year, right? So bonds in particular are usually semi-annual. Some of these, so receive 900 at the end of each 6 months for the next 15 years. So again, we have an annuity, we have a payment of $900, but how many payments do we actually have? We have 30. Not 15, because we're receiving 2 a year. So whenever you have more than one payment in a year, you have to take the payment amount and divide it by 2 or whatever generally, but here you don't have to divide it because the way they worded it. So here's where you do have to pay attention to wording. Okay, they tell you you're receiving it every 6 months, so you really are receiving $1,800 a year. Rather than saying the bond pays $1,800 interest and pays $1,800 interest semi-annually, you would divide it in half. This tells us it's already every 6 months. So be careful of that, right? But what do you have to do to the interest rate here?
Divide it in half.
Divide it in half. Because interest rates are always quoted on an annual basis. Always. Okay? So it's 5%, not 10%. Okay? So question 5, between the feedback you got on your time value of money assignment, what we did at the Ridges, the task out sheets, you should be able to get through this pretty quickly and use Excel and shouldn't be any issues. Okay, question 6. Oh, this is just asking to distinguish between balance sheet and income statement accounts, right? So what's a balance sheet? Show us technical definitions. The balance sheet shows us the economic resources of the organization and the claims against those resources at one point in time, right? And what do we call economic resources? Assets. So what do we call claims? Either liabilities or equity, okay? So if it's something I owe, okay, or it's something I own, okay, it goes on a balance sheet. What does an income statement show? Income statement shows revenues and expenses over a period of time. Any type of gain or loss or revenue or expense is an income statement item. Okay? The names and titles of these accounts are very clear. There is no confusion, there's no trickery. Just classify them, whether they're an income statement or a balance sheet item. Question 7 is some more cash flow. I would suspect 7 and 10 will be the two challenging questions. We've talked about 10 in detail, so you should be able to get through 7 relatively easily. If you got through 10, you're only doing the operating section of the cash flow statement. In 7, you're doing a full cash flow statement in 10. In 8, you're doing invested in finance section instead of operating. So you got 3 cash flow statements here, really. And then question 9 is, well, you got 4 classifications of what they are: operating, invested, or financing activities. And I just explained the difference between them: income statement and changes in current assets, current liabilities; operating, investments, long-term assets, investing; liabilities, i.e. interest-bearing liabilities is what I should say; and equity, financing. Okay. Yes. Oh, you were just taking your glasses off. I thought I had a question. I got excited.
Interest-bearing liabilities, you said investing, but long-term,
No, interest-bearing liabilities, it says financing.
oh, thank God, because that just confused me, because about bonds, I'm like, hold on. Okay.
If I did say that, I didn't know what I was saying.
Okay. So under investing, I just have long-term assets and PPE.
That's correct. Well, the only clarification in that, you might want to say investments and PP&E. Okay, because you can have short-term investments, but and it's still going to be investment activity. I.e., I can have excess cash sitting around, and I can go invest in some other company's common stock. Okay, it's obviously not operations unless I'm a brokerage firm that's in the business of investing. That's where it can get tricky, right? So, but investments and PP&E are generally the 2 long-term assets we're talking about.
So short-term investments.
Yes. Marketable securities, not investments in receivables and inventories.
Just wondering. You just got here, so you have a question.
I've been out of town, so.
I got a question just to understand the supplemental cash flow disclosures.
Yes.
Right. So what the purpose of them is they're disclosing the cash outflow of certain things, whether it be interest expense or, right? And so cash outflow would be different than what is reported on the income statement.
Yes, that's why you have to disclose it.
And why would it be different? Because okay, hold on, let me just think through this. It's gonna be different because interest expense on an income statement includes a number of things, not necessarily just the cash flow. Is that the right way to say it? Or how would you say it?
The interest expense on the income statement is the expense that was incurred during the current period for the use of money.
Mhm.
Just because it was incurred doesn't mean it was paid. Let me make this real
I
simple.
get it. I know that helped because the income statement shows, because as soon as you, in the balance sheet, when you record a liability, it hits the income statement even though the cash didn't flow at that point.
Correct.
That was where I was
Correct. So that's where you got it. And the example I was going to give you to make it really easy to understand is it is June or July 1, and I truck up to my bank and say I need 100,000. I got to do a tenant build out on this suite to get this tenant in here, and it's going to cost me $100,000. And I would like to borrow $100,000 to get that done. And when it's done and he moves in, he's going to give me the $100,000. Okay. So will you lend me $100,000 on a 1-year note? Okay. I'm going to pay principal and interest 1 year from now. Yes, I will. 6 months go by, I got to produce a year-end financial statement. Did I incur interest expense? Most definitely. I used their money for half a year, and I don't have any expense on my balance sheet, on my income statement. I must accrue it. So I accrue that expense. I have zero cash outflow.
Okay.
6 months in a new year, I pay it. The interest expense on the second year's income statement is way more than what my interest expense really is. The cash that I paid is more because I got the full year. So the cash flow supplemental disclosures makes us disclose what was paid for income tax and what was paid for interest expense because they're two pretty important numbers. Okay. The other supplemental disclosures requires us to disclose any assets acquired for other than cash. Okay. Many times you go up and I go trucking to the store and buy a brand new service truck and I just sign a little note and I drive out the door. Do I have a cash outflow of $50,000 for that truck from investing activities? Absolutely not, because the cash never came, I didn't write a check, okay? And do I have a financing activity of $50,000 coming in the door? No, because it did not go through my cash account. Now, if I happen to go to my bank and say I'm on my way to the dealer to buy a truck and it's $50,000, will you write the check to me, okay, put it in my checking account, I'm gonna go there and pay the dealer, then I have both investing and financing activities. But when they're netted, you gotta disclose it. And you have a net up there. It tells you they acquired $65,000 worth of equipment with the issuance of a bond. Okay.
Yeah, so they paid for that equipment with bonds, essentially.
Mm-hmm.
Okay. Okay.
Question?
Well, back on number 5, where you said you could do it with the table value or the present value calculation.
Yeah.
I did them all both ways to check my work, and I had 2 that didn't come out the same, to the tune of $1.
Well, all I could tell you is I did not use the tables.
Okay.
I did use Excel. I did this assignment about an hour ago. And I entered my answers from Excel and they were all 100% correct.
Okay.
Okay. You're welcome.
I can do that then.
Are you sure when you use the table, you use all the decimal places that were provided?
I think so. I've just double checked it in the book.
Okay.
And oddly enough, it's the same table value both times I'm off by $1, which is why I thought maybe I got the table value wrong, but I don't think I did.
When we break or when we're done,
Uh-huh.
I want to see your table number and I want to stick it
Okay.
in here. Actually, let's do that now, because if that table is going to produce an answer that's going to make someone wrong, that's right.
Well, and double check, I mean, maybe I've done something crazy, but both times I have that one table value, it's off by $1.
Okay, so which question are you specifically talking about?
It's the first one on A and D.
So 0.385554.
Is it 5.4? I only have 2 5s.
38554.
38554. Yeah, that's what I've got. That's the actual calculation. That's rounding to the nearest dollar.
Okay, so they want it in whole dollars, so how come you say they're off $1? They're both in.
No, because that's the present value function.
Okay.
And when I apply the rounding to that, it goes to that. That's the table value. When I apply a rounding to that, it goes to that.
It will mark. Oh, I thought I blocked that out. It will mark both of them as correct. So I did not use the tables. I used
Okay.
Excel. So not an issue.
Interesting.
Not an
That
issue.
is interesting. That is interesting.
Computer's a smidge smarter than we gave it credit for.
Yeah, and I bet you if we go $1 more off, it will say it's wrong. Okay, so yeah, I'm sure they realize that in today's day and age, many people are going to use Excel or a.
Well, I did it both ways and wondered if they were trying to trick me by telling me to use the table value.
Yeah.
That's
Yeah.
why I asked.
No, we're good. We're good. So if we were to happen to go. Yeah. So it's got it.
Interesting. Huh. Try, just because I'm curious now, try 5120.20.
Oh, that'll be wrong.
That'll be wrong?
It will not take, because it says